Okay. Welcome back to Mastering Complexity. Joined today by James Purcell, sustainable investing expert and new author. James, thanks so much for being here today.
Thank you very much for the invitation.
My pleasure. Now, I thought we could just start this conversation. I'd love to know a little bit about what led up to you working on and eventually publishing this book on sustainable investing. How did it all get started?
So it started off with my colleague and I, my co-author, a gentleman called Simon Smiles. We worked in sustainable investing for several years. And really what we were seeing was quite a polarization in the industry. You had this one wing that was extremely passionate about sustainability, thought it could do no wrong. And then this other counter-surgency, if you will, where people were beginning to demonize ESG and sustainability. And what we wanted to do was try and get the middle path to show the genuine pros and cons, what works, what doesn't, what can be improved, and to do it from a position of experience, having done this for several years at leading financial firms.
That makes sense. Now, there's so many stakeholders that come to play in this industry. Can you talk to me a little bit about what you learned about each of the major stakeholders here? Anything interesting, exciting pop out to you?
I think a couple of things jump off the page. The first is about investors. And the truth about investors when it comes to sustainability is that only a fraction of them are truly passionate about sustainability. Most people are open to the idea. Most people are willing to engage, but it's not their first priority. So if the returns are sensible, if the costs are sensible, then you'll get a large portion of people engaging on the topic. But otherwise, I think people can often overestimate how much people care. And it's getting that balance right and making sure that you appeal to that wide spectrum and not just a small echo chamber. That's really the key, I think, when it comes to investors as a stakeholder.
Very good. And now what about for the banks? Let's use them as a second stakeholder, the financial institutions or companies that have to disclose sort of sustainability or ESG information. What popped out to you here?
So I think with banks, it comes down to incentives and creating win-win environments. So if you do sustainability in a genuine way, in a credible way, there are many positive commercial outcomes that you can obtain. For example, if you do this well, it's a ticket to faster growth. If we think about who is most interested in sustainability, it is people who are growing their wealth extremely fast. It is next gens who are inheriting and they're earning, it's entrepreneurs, etc. So if you're looking for a pathway to faster growth, then sustainability is a great way to get there. There's also some other really good commercial elements to sustainability. The obvious one is that it's emotive. And because it's emotive, it creates dynamics that can be favorable for price, favorable for retention. And these two are, of course, desirable from a commercial standpoint. So I think when sustainability is done well, it's commercial and credible simultaneously. And banks that achieve that are better positioned than others going forward.
And now part of doing something well, I mean, there's sort of an arena of consistency there that has to be applied. And that brings us to the sort of, I would say, two of the last major stakeholders here. That's regulators and the ratings agencies. Now, there's a lot of overlap between these two, and the interplay is, well, it's also, there's some disparity too, I know about. So what can you tell us about the regulators and the rating agencies and what the role that they play in this arena?
So when it comes to the regulators, they've almost been forced to step in. The industry has grown very fast, but has largely failed to self-regulate. And what I mean by that is many of the criticisms levied at the industry haven't been adequately resolved. So therefore, we've got the regulators now coming in with an awful lot of legislation on both sides of the Atlantic. And in many ways, they're becoming the most important stakeholder in this because the freedom of choice is being diminished by the regulators. And this has some positives. In some areas, it's great to have consistency. It's really good to have consistency when it comes to the data that is reported by companies. It would be a wonderful scenario that people are reporting consistently in a way that you can compare. It can also be not so good when you're trying to get consistency at other steps in the value chain. We should remember that sustainability, of course, is often about personal choice. People have different preferences, people have different interests, and we need to make sure that we maintain that freedom of choice, that diversity through this process. So the regulators are absolutely a key stakeholder, but it's also a very difficult path to walk.
Yeah, now, I mean, from the outside looking in, you mentioned something interesting. The outside looking in, one would think that, aiming towards consistency or a single framework would be sort of the aim for the majority of these stakeholders, but it sounds like there's almost like an anti-harmony lobby here. Can you tell me a little bit more about sort of why that might be? Is there there's value to be found in chaos or something like this?
I think there are many elements to it, and incentives has always played a big role. So from the investor side, there are certainly groups of investors that do find value in the chaos, as you say. The fact that we don't have standardization, the fact that we don't have harmonization gives them the opportunity to uncover things that other people might have missed. So there's certainly a portion of investors who are not so keen on having standardization. That's also true with some of the data providers, the rating providers within sustainability. A lot of their value add comes from making sense of a complex world. And thus they too have, sometimes incentives to try and prolong the status quo. But I do also think there's a slightly more fundamental reason for the divergence, which is as simple as that different people have different opinions. If we were to sit here and throw out, a list of company names and see how sustainable we think they are, we're bound to disagree at certain points. It's absolutely okay that people have different opinions. And this can be from a values perspective. Some people like alcohol, some people don't. Some people like to smoke, some people don't. It can also be from an investment point of view, where we think different things may impact the future of the company from a sustainability perspective. So there's some incentives at play, but there's also some fundamental reasons why diversity exists.
And what can you tell me about the real world impact of when a rating agency, let's say, changes something, updates some of their metrics? What does this mean for the market? Have you noticed anything there?
So by and large, these updates do not create market-moving information. And that's because there is a lag to these processes. If someone needs to update a rating, they need to go through a process. They need to make sure that their methodology and data is accurate, and that takes time. So we'll often see news stories that break be a precursor to a change in ratings, not the other way around. So the first order effect is not overly significant. But there is a second order effect, which is increasingly certain pockets of the market are becoming quite heavily dependent upon the rating agencies. So in particular in the passive space, where a number of indexes and resultant tracking products have been built, here, because it's mechanically taken through the ratings into the investment product, we do see that second order effect, where you will see flows as a result of changes in rating agencies, and those flows will also have a price impact. When it comes to the academic studies, it does seem to show that there is one rating agency provider that is more dominant than others when it comes to material impacts. But we are starting to see, as I say, that second order effect, which is a flow-based argument, come into effect.
Gotcha. Now you're mentioning academic studies here. I want to tie that back to the title of the book, that's Sustainable Investing in Practice. Now, we've talked a little bit about disparity already here. What can you tell me about that disconnect from the academic world to the real world? What did you find there? How are things being treated?
So I think the big disconnect is the disconnect between the ever-changing world of sustainability and practice. It's not constant. And in the academic world, the need to have consistent data series for analysis. So if you want to do a quantitative analysis, you need to have 20 years, perhaps 30 years of history. You want that methodology to be consistent over time. You don't want there to be subjective overrides, of course. And that necessitates a certain type of analysis if you are creating those constraints in order to get a great time series for analytics. The problem with that, of course, is the world has changed an awful lot when it comes to sustainability and sustainable investing over the last 30 years. So that's often where we see the disconnect between the academic world and the world in practice. It's well-intentioned, that disconnect, but it is a function of the necessity and the different objectives that are being undertaken.
Right, these incentive alignments, as you discussed. Now, we talked a little bit about data there. Of course, this is a huge issue in the space. What can you tell us about the state of how data is collected, provided, aggregated? What's going on there?
So sustainable data, I think, is the start of any process. If you don't have good data, it's very hard to make informed decisions. And that's true of any vertical, including sustainability. What we see when we look at sustainability data is there's lots of it. It's just not necessarily of the highest quality. The lack of outstanding standards normally means you get very limited comparability between two companies. You get a lot of what we refer to as scope mismatches, so data that on the surface looks the same, but actually has different perimeters, be it slight differences in geographies or slightly different definitions. And the result that you normally find is you find a fraction, we're talking sub 20% of data that is truly usable for an investment case and truly comparable between companies. So there's an awful lot that people need to fill in, if that makes sense, so need to interpret. And we're not yet at a stage where you can use data without going through that process. And that, of course, restricts the ability of many people to utilize the data efficiently, and also, thus means it remains a specialist area in its own right.
Now, looking ahead, what sort of initiatives do you see being pushed either from regulators or even from market participants that is looking to synthesize some of this data, create these generalized frameworks? What's happening internationally?
So we're on the cusp of a huge change. What's happened in the last 12 months is that two of the biggest players have come together. So what was referred to as the Sustainable Accounting Standards Board, or SASB, which was by and large the leading framework of how to disclose financially material data, has come together with IFRS, which is one of the two big accounting standards in the world, the other one being US GAAP, of course. And that is an absolute game changer, because you've got a sustainability-focused organization of extremely high quality coming together with a organization that knows how to have worldwide reach, that knows how to drive consistency, that knows how to bring credibility. And that combination has the potential to be a new global baseline for sustainability reporting. Now, it's not something that will happen overnight. I'm sure many jurisdictions will choose slightly different routes, but it is a wonderful starting point, which we haven't had previously, to build a consistent architecture and ecosystem for sustainability data. That is not without its controversies. That combination is very much focused on what we would call financially material data, i.e. data that is of interest to investors, when of course there are many other stakeholders out there in the world who are interested in data that might be relevant to employees or the community, etc. and so forth. So there is a little bit of a pushback on this idea because the scope is relatively narrow. It's focused purely on that financial materiality. But as a starting point, it's a superb place in my mind to bring consistency.
That makes a lot of sense. Now, of course, from the investor perspective, but also other stakeholders, there's a lot of confusion. There's variance in the data delivered. There's variance all over the place. And something I liked about your book was that you really brought together some imagery, some metaphor usage that kind of did a great job to sum up sort of what the problems are. And one of the early ones you used was a supermarket. You used that as a jumping off point. Can you walk us through your thoughts on that?
Sure. So I think this analogy is really focused on what makes people buy things, what makes people act as a consumer. And the current state of the sustainable investing industry, we make an analogy to a supermarket, where in that supermarket you will find products that are essentially mislabeled. So you'll have your sugar that has a label which says flour, you'll have your flour which has a label that says salt. The salt will be completely unlabeled. And when you ask for help from the cashier, you get spoken to in a language that you don't understand. Now, if that was the scenario when you walked into a shop, you're going to pretty quickly turn around and walk out of there without making a purchase. And in many ways, that's what we're facing when it comes to the sustainable investing industry. Lots of things that are using similar words. Sometimes those words are interchangeable, sometimes they're not. Lots of times when things are labeled differently between different providers, and a lot of jargon, a lot of acronyms can get in the way as well. And if that's the environment that you're in, it's not conducive to bringing people on side. It's not conducive to sales. It's not conducive to crowding in capital to perform good for people and planet. And that's really, as I said, I think a good way of viewing the current state of the sustainable investing industry.
Very good. I really liked it. And there's a few others scattered through the book there that I thought were really great. I'm wondering if you could tell me a little bit. You've got, I think, 9 chapters in the book, and it seems like each one features a colleague of yours or someone from the space with a whole bunch of different perspectives and some great insights. Why don't you walk us through some of the key ones there that you were able to bring out?
So at an early stage, my co-author and I, were hopefully humble enough to realize that there are people that are a lot smarter than we are, that we met over the course of our careers. So we reached out to, as you say, 7 of them to provide insights in the form of an interview, and one broadly speaking relevant for each of the different chapters. And for us, it was really important, I think, to get that diversity of thought in there, rather than just having ourselves go back and forth in our own little echo chamber. So we were fortunate enough to get the likes of Paul Owen, who formerly, of course, was the CEO of Unilever and has continued to do great work since. Richard Curtis, who, in addition to being a world-famous filmmaker, has done wonders for the charitable space, and also in a range of, mass engagement initiatives around things such as pensions and climate. And again, a handful of other people, Gillian Tett from the FT, for example, General Petraeus, former director of the CIA. So a wonderful group of people, but with a very diverse profile. So if we look through it, it's a combination of a former CEO, with a former army general, with a journalist, etc., and so forth, an academic. And it's about bringing that diversity of viewpoints through. And to me, it was the best part of the book, to be honest. I had the opportunity to speak to those 7 individuals and to bring their thoughts to paper alongside Simon and my own.
Absolutely. It sounds like a lot of fun and quite a list of characters. How did you line up the ex-CIA director? That's an interesting one.
He is someone who actually, again, works adjacently, shall we say, to the sustainability field. He works for a large private equity firm as one of his many roles after a career of public service. And thus, Simon and I originally met him through that private equity firm when they were launching a sustainability-focused product. So all these people have come to sustainability through different paths, and that's to me what made it so exciting, which is it's not just copying and paste the same story. It's people who have come here for different reasons over time.
Absolutely. There's different points, different viewpoints, different lenses to see this through. I'm wondering your own background and experience working in this space, and now too being able to leverage these insights. If we were to look ahead 5-10 years, are there a few sort of key things on the horizon you think might really change the sustainable investing landscape that we could look forward to?
I think if I was to draw out the key changes, I think the first is going to be the standardization of data. That is coming. It has its pros and negatives, but one way or another, we will end up in a place where companies are, broadly speaking, reporting the same information in the same manner. And that's a great baseline, I think, for all financial analysis thereafter. The second thing that I think will occur is an increasing realization that real-world impact, real-world change is predominantly created in private markets rather than public markets. And what I mean by that is if today you and I were to buy shares in any given tech company, no money goes to that tech company. It gets exchanged between investors and secondary markets. So we don't actually change the operations of the company that we buy or sell shares in. In contrast, of course, in private markets, more often than not, your money is incremental capital. It's going onto the balance sheet of that company. It's helping them grow. It's helping them bring their products and services to a broader scale. And that, of course, creates a lot more real-world impact when you can transform the ability of a company to do business. So I think we'll see an increased focus on the private markets, and we'll see that as a mechanism for change and a mechanism for sustainable investing to get ever larger. So I think that they're probably the two that I draw out: standardization on data and a shift from public to private markets.
Absolutely. Now, a bit of a tumultuous topic, but some people have looked at something that the market's calling the green bubble. What can you tell me about this and where it started from, what it means?
So the concept of a green bubble is suggesting that certain financial assets that have green characteristics are overvalued versus their fundamentals. And like most things, it's a function of supply and demand. And there's been some evidence over the last few years that those companies that are providing the most intuitive or the most advanced products and services that have a clear societal or planetary benefit have become ever more popular with a group of investors, and thus their valuations have been pushed up accordingly. What was interesting is this really coincided with a period of ultra-low interest rates. And as interest rates have risen, by and large, this, if one wants to call it a bubble, has deflated. And it's one thing that we always need to keep an eye on for any investment, which is, are the fundamentals connected fully to the valuation? And just because something is sustainable, quote unquote, doesn't make it an exemption or an exception to that rule. So rising interest rates have changed a lot in financial markets. And one of the things it's done is perhaps made people slightly more critical, if you will, of some of these green assets and their revenue potential over the near term.
Now that's interesting, this investor critical nature. In your own work, speaking with clients, speaking with investors, have you noticed this too? A bit of a rise of this unsureness or a look for more clarity in the space?
So I think there's a couple of dynamics at play there. The first is there always has been and there always will be a group of people who are, for whatever reason, less favorably exposed to sustainability. And that should be accepted, which is everyone is entitled to have their own views. We may not always agree with them, but they're entitled to hold those positions. So there's definitely a portion of the general population and, of course, investors who hold a less favorable view about sustainability. And that's been true in the past, and I'm sure it'll be true going forward. There's another portion of the population that I think has been slightly unnerved by some of the, I guess, greenwashing, to use a slightly technical term, where companies, not just financial companies, but companies in general, have had some of their sustainability practices questioned for their authenticity. And I think that's unnerved a fair few people because it makes them question, and rightly so, question what they're receiving and whether the products and services that they're buying truly do have the favorable sustainability profile that they believe they once did.
Yeah, that makes a lot of sense. And I'm wondering exactly to address those issues there. And as sustainable investing becomes even more incorporated into sort of general wealth management, what do you think this move, this paradigm shift will mean for relationship managers themselves, or those dealing with clients? A lot of education is going to need to be there as well, something so they can pass on and bypass or address some of these concerns by the investors. What do you think?
So normally when someone says, do our relationship managers need more education? My answer is no, which is they already know about their clients' interests. They already know about their clients' passions. They already know an awful lot around the values of the people that they work with. All that we're asking to do is to try and translate that to build an ever stronger relationship between the client and the relationship manager. So I really don't think it's a case of educating relationship managers. I think it's more the opposite in some ways, making sure that those people in the sustainable investing industry are speaking a very human language, that they're not creating unnecessary jargon, that they're not making things too technical. Because then when you have that environment with a lot of technical jargon, you do educate people. But I'd much rather make sustainability accessible, much rather make it something that everyone can understand without needing to have specialized training. And there I think you'll get far more buy-in and a far greater success as a consequence.
Yeah, just a translation to something a little bit more tangible. I know something you were talking about was, you talk about a carbon footprint, but using airplane trips around the globe or something like that.
Absolutely. And I think this is where any specialist sector, again, sustainable investing included, can often make a mistake. They talk in language that reflects their own level of understanding, and they talk as if they're talking to their industry peers. And of course, in any industry, 99% of the population is not your industry peer. They work in a different sector. Thus, it's not for us to try and bring everyone to this supposedly higher standard. Far from it. I think it's for us to make sure that we're speaking in a way that can engage people.
Absolutely. Now, I wanted to just drill down into one last topic here, and that is E, S, and G. Now, each of these factors carries their own assessments and things like this. I'm curious if you had any insights from the regulatory side, from the ratings agencies. Is there hierarchies about what has more importance? And how do you see this evolving moving forward? Are we going to continue to see sort of a conglomerate rating? Are these going to be detached a little bit? What do you see?
So I think the history of ESG, a lot of the success, and of course it has been successful, rests on the G. So governance was always considered to be something that was important to investors. And by partnering E and S with G, it brought a degree of credibility and also a degree of attention to E and S. So that was a really smart thing to do, I must say, bringing those three together to leverage the strength of the governance pillar. So governance has and will continue to be a hugely important part of any investment process, whether it be sustainability focused or not. I think what we're seeing on the other pillars, in the E pillar, where it's quite interesting, we're beginning to see the rise of biodiversity. So for a long time, we've been focused on climate. Now nature and biodiversity seem to be rising on most investors' agendas. And that's really, I think, quite exciting to begin to see the environmental pillar become a lot more multidimensional. And then the social topics, again, I believe they are beginning to become more widely understood with their nuances. We spent a long time, of course, focused on quite a narrow interpretation of diversity. Often that's been limited to gender. And increasingly what we see is topics around diversity being, again, broadened out with a better understanding of diversity across multiple dimensions. So I think, like many different businesses, as things become more mature, they become more specialized. And so I would expect the ESG to begin to separate out to some degree, and for more clearly defined sub-pillars, if you will, in each of those categories, become ever more prominent in investor discussions.
Absolutely. Hey, thanks so much. Now, James, why don't you tell the people where can they find more about you, about the book? It's available online, every good bookstore. Where can we find you?
Indeed. So you can find me, of course, online, for example, via my website, which is jamespurcell.com, surprisingly. And you can find the book, as you say, in all good bookstores. It's available at physical bookstores, the likes of Barnes & Noble and Waterstones, depending on the point of geography. But of course, it's also available online with Amazon stocking it in all jurisdictions as well. So very much appreciate you giving me the opportunity to talk about the book.
Hey, my pleasure. Thanks again for coming in, and look forward to catching up as this industry continues to evolve.
Thank you very much.
Thanks, James.